What should a chairman of the Federal Reserve System do in a time of crisis and war? Stay on plan or amend to the politicians?
Let me just first say that I was very proud of our president last night. I thought the way in which he spoke to the stakes of what we're involved in Ukraine, what we're involved in, and what the obligation of the United States is to uphold world order at a moment like this was profoundly important and profoundly inspiring. And we're going to talk about economic and financial stuff in just a minute, Tom, and I'm happy to do that. But the real stakes are in freedom, in the maintenance of civilization, in the resistance to naked aggression. And history is going to remember that a lot longer than it's going to remember anything with the Fed funds rate.
Larry, I think a lot of people would agree with you. Oh, I'm sorry, so sorry. But to follow on, to really get to the Fed funds rate, you know, what is the cost the U.S. is willing to bear when you talk about exactly preserving those freedoms, and then the Fed's role in trying to tamp down? Have they already missed the boat on that?
I think the Fed's been very late. I think it's been way behind the curve. And I think one of the reasons why it's costly when you're behind the curve is that sometimes you can get shocks that make it harder for you to act. But I don't think the Fed has any alternative now but to mount a strong response to inflation at a time when I think we are at or over the brink of a spiral of rising inflation breaking out. You're seeing that in the numbers for expected inflation over the next year or over the next couple of years. The place you're seeing it most clearly is in the wage data and the data on vacancies, which are pointing to wage inflation at close to 6%, and pressures for that to accelerate. And I think that needs to be ringing all the alarm bells at the Fed.
Yeah.
So I think there's much more risk of the Fed doing too little than there is of the Fed doing too much at a moment like this. I think the Fed's obsession with a high-pressure economy was way excessive because they didn't think about how pressured an economy we were going to be able to have over the longer term. And I think the next recession probably has mistaken monetary policy written all over it.
Larry, there was a discussion about this before the invasion of Ukraine by Russia, that perhaps the Fed was way too late and had to move very quickly. Now the suggestion coming from markets is that even if the Fed moves quickly, it's not going to matter in terms of staving off a near-term recession. It's not going to matter in terms of landing this economy in a more controlled way. Do you agree with that sentiment?
I think the difficulty of getting a soft landing where we both brought inflation down and we avoided recession was always very difficult. And I think with $110 oil, it is that much more difficult. And so I think we're going to have to, if we want to bring down inflation and we don't have a financial accident, we're going to need to see interest rates higher than the Fed or markets are now pricing in.
Larry, David Folkerts-Landau, of course, of the academics of Dooley, Folkerts-Landau, and Garber, and at Deutsche Bank now, is suggesting the EU will need intervention to see strong dollar become a weaker dollar. He's worried about too weak of a euro as well. He made very clear that this time around it is a less than coordinated intervention. Can a singular intervention work at any time and place?
I don't think the track record on currency interventions is very encouraging. I don't envision that you're likely to see a currency intervention by the United States to weaken the dollar, nor is that something that I would advocate. Very much the contrary. I suspect that that the more relevant tool is the use of monetary policy rather than currency intervention.